Alrighty, everyone, I thought I'd have a little bit of fun today and compare bonds, 20-year bonds to IULs, because so many times I've been pitched and told that the IUL is like this phenomenal way to save for your retirement. And while yes, it's a kind of a good alternative to some fixed investments, I would say that it's not good unless you have a ton of money. So I did a comparison on the 20-year bonds over a 40-year period versus an IUL over that same 40-year period. And just so that you like, what the heck's this guy on YouTube talking about? I am a ex-financial advisor. I used to work for Ameriprise, and I currently have my insurance licenses only, where I help people with Medicare insurance, health insurance, and other things like that. But for this information and all this stuff going on here, just basically know that I'm just trying to figure this out for myself, and I wanted to share the findings because I thought it was pretty cool, especially that we can use ChatGPT to kind of run through all the scenarios, so long as you tell it the right things. If you tell it the wrong things, it'll pretty much just generate what the illustrations today are illustrating. And I'll kind of go over the plus and minuses on how and why ChatGPT kind of made the assumptions that I didn't want it to make initially. So when you look at a normal illustration from, let's call it Mutual of Omaha, because that's the one that I used. Where are we? Here we go. Oops. So what IULs typically do is they look past for a 20-year period, and then they take the average of what the index is gonna do, and they come up with this number here, 6.3, and they apply the average return rate of 6.3 to all the years that is accumulating. So if we go further down, this is an illustration, by the way, for permanent life insurance. This is one that I ran on a hypothetical person, 45-year-old male, retiring in 20 years at 65 and dispersing the policy until it runs out of money. If you look on the, there we go, illustrations, it will tell you this is 4%, this is 6.3, but it's every single year. And as many of you know, market doesn't really work every single year. We can show that it does, but it doesn't always. So this is what you'd get, and then you'd be looking at this number here and be like, wow, I can take out $11,000 for a long time, up until 90, from 65 to 90, that's 25 years, and I still end up with some surrender value and some death benefit. And that's kind of the whole pitch on why life insurance is the better choice for saving money and tax accumulation, or tax savings and asset accumulation, because it's technically not an investment. It's insurance, and insurance cannot be an investment. It's a risk diversifier or risk transfer product. So basically, if you go back to my wonderful ChatGPT example here, so what it does is I'm doing $5,000 per month, or sorry, $5,000 per year, $5,000 per month, then the life insurance probably would outperform. But if you're doing $5,000 a month, which is more in line with what somebody would be putting away in today's world, which is nowhere near enough in my opinion, but let's just take it from there. $5,000 a month, either they're putting it into 20-year treasuries or they're putting it into this IUL policy. And because I'm going to use actual data, I'm going to use data from 40 years ago, so 1983 to 2023. And the way that ChatGPT is going to look at this, it's going to take the starting value of the open market day for the S&P 500 and then the closing day of that same year, and it's going to look at that amount to get the interest rate. Now what it's doing for the bonds is it's buying $5,000 of a 20-year treasury bond, and whatever coupon that it has, it will accumulate, and then at the start of the next year, it will buy another 20-year bond with the $5,000 plus whatever interest coupon rate it accumulated in that first year, and then the second year, third year, fourth year, etc. So that's how the bond logic is going to be kind of growing, right? And then after that's all done, ChatGPT is going to say how much or how long it can disburse that accumulated value at the 20-year mark over the next 20 years to last until the person is 85 in this example. And it did quite a good job, except the first time I did it, it gave me an average return rate of 8%, just so that we know that IUL, the way that IULs are made is there's a floor, like you can't earn less than 0%, so your money cash value cannot go down due to changes in the market. And they have a cap. So for this example, I used a 10% cap. So like if the market went 25% or 100%, the most you could get is 10. But if the market went down 50%, you wouldn't have any change in value due to the investment performance of setting index. So that's how that works. Now we did all this wonderful calculation, and I had to like tell it all these things because it was like numbers just didn't math out for me. So what I ended up doing after all this back and forth is, because see here it's like, oh, it's 6%, so we're just going to do 6% forever, and policy charge 1.5, and I was like, nah, that's not really how IULs work. So instead, after all this back and forth with me and ChatGPT to figure out the best way to do this, as you can see here, the first way that it did it was it calculated the average rate of this, which it said was, gosh, where did they say the average rate was? I think they said the average rate was like either 8 or 6.5 or something. And then the Treasury bonds was average yield of 4. And I was like, don't do averages. I want every single year's return, not just what the average would be. And so it pulled, thankfully, all of the historical returns for the S&P 500, and then all of the historical return yields for the 20-year Treasury. So after it did all of its wonderful Python pulling all that stuff for me, it developed a table which I then extrapolated here. Now the beautiful part was that the rates from the IUL cash value versus the Treasury bond were actually, over the 20 years, really close. So over the past 20 years, from 1983 to 2003, the market, if you had an IUL, and then the Treasury bond yield were less than $1,000 difference if you did CAGR, compound annual growth rate, which is what this thing calculates. And I thought, oh, that's pretty amazing. And then we did the distribution all the way down to the end of the 20-year period, which I had to then revamp, because what this did was it took the total remaining value divided by the amount of years that it wanted me to distribute less, and then it kept pulling it lower and lower and lower and lower. And that's really not how I wanted it to distribute. I wanted to distribute all the money that it could in a standardized fashion. So not like decelerating like this. I wanted it to be constant. So then we had to do some more calculations, more fun stuff. And finally, I was able to pull out this chart here. So same, about 200,000 after 20 years of putting in 5,000 a year, which is pretty good. You doubled your money after 20 years. Not the greatest, but I mean, we're looking at fixed products typically, right? The IUL, which is returning somewhere in the realm of 6% minus policy fees, and then the Treasury bonds, which are bringing back average of 4%. Now I'm using all these averages just to make it easy for you to understand, but just note that the calculations were done based on the actual amounts given the IUL parameters of 0 floor, 10 cap, and the actual yields of all the Treasury bonds if you had bought one every single year. And now we have disbursements. So the disbursements, as you can see, this is the IUL column, and this is the life insurance IUL, and then the Treasury. And this is the remaining balance in the account. And mind you, it's still set to be growing at this point. It's not like they're just in cash and it's getting liquidated out. They're still accumulating their returns based on the return or the yield of either the Treasury bonds or the IUL credits based on 0 to 10 and the 1.5% policy fee. And we kind of show that they all ran out of money on the last year, and the IUL distributes 11,200, and the Treasury is pretty much almost the same with like a $50 delta, right? It's barely any change per year. So it's very, very close to the Treasury bond. Now, with that said, if we ran, which I did, I wanted to show what an illustration would look like and how far close it would be to what my kind of with ChatGPT and running through back data and back testing how it would look. And it's actually quite close. The closeness was actually pretty surprising based on the non-illustrated interest rate. So the higher, right, the average over the last 20 years, which they use was 6.3%. And they capped out, where are we? So 5% going in, non-surrender values, accumulated values are going in. Accumulated value kind of goes up to, let's call it, well, actually doesn't go up that high, it's less. So the accumulated value before they start taking out is 158, and that's based off of the 6.3%. But due to the compounding and the way that it keeps growing and you can loan off in the cash right and whatnot, it goes a little bit, it keeps growing to offset the loan value. And it lasts until age 90. So the illustration is pretty close to what I came up with, but it's not going to outperform pretty much anything else other than the 20-year Treasury. So with this one, as you can see, we're able to pull out under non-guarantee optimal kind of conditions. We're able to pull out over 25 years, $11,000, which is $266,000 or so. Not a bad deal, but it's non-guaranteed. So this is like on the optimal side of things. If we looked at the less optimal and go with a midpoint, right, the 4%, it actually only lasts till 76, which is not bad. 76 is the life expectancy for most adults in the US, but that's kind of sad because we only start taking it out when we're 65, so it only lasts about 11 years. So that's not ideal. Now, what would I do if this was my money? I wouldn't buy an IUL for this. I personally have an IUL. In fact, I have this IUL, but mine is structured to last till I'm 90. And it's structured to be kind of a min pay max benefit, so that over the next, till I'm 90, I pay the same amount of money every year, and I have the same amount of coverage forever. And that same amount of coverage is $250,000, so it's pretty close to this one. And I'm paying about $1,200 a year for mine, not $5,000. Now one could argue that, well, for an extra $3,500 a year, I could have all this extra, whatever benefit, but it's not my thing. I keep the insurance to do insurance stuff until I make, until I have like so much money that I have to use these kinds of vehicles in order to put money aside and get tax-free benefits, right? Because the thing that I'm not talking about, and maybe you guys in the comments are wondering about, is what about the tax efficiency of something like this? I mean, for the Treasury bond, we're paying taxes on the yields every single year, right? And I'd say, yes, you are. You're paying taxes on the yields every single year. When you take the money out, though, you're not paying any taxes because you're already paying every single year. You pay on the growth. You pay when it's realized, when the coupon or when the bond matures. You're paying all. If you have all the interest bundled up in one, it really depends on how the Treasury yields are set up. If you have it in an IRA or a Roth account, that changes too. So there's lots of different things when it comes to how the bonds are going to be taxed. Because if federal, you'd be paying taxes on your state. If some states, you have to pay taxes on the income that you get from things like bonds. Whereas life insurance, you don't have to. Now the problem, though, with the life insurance is that if it lapses, whatever you make, you have to pay taxes on. And that can be problematic. Also, with the life insurance, you cannot take out more than your cash value allows. So you wouldn't be able to have any kind of liquidation event before the 14-year surrender period on this thing. So while yes, the treasury bonds are being invested into things that are going to be locked in, like bonds have a mark to market, but it might not be selling, or you might not be able to get rid of it for the face value, like the bond face value, like $5,000. You might have to sell it for less if the interest rates went up. But on the flip side, if the interest rates went down, you could sell it for more, but you'd lose that coupon rate. And yield to maturity is a whole different calculation that if you want to, we could go over. But for the most part, for this particular example, the only reason why somebody would choose this route, the life insurance route, over the bond route, is if you're looking for the flexibility of the life insurance policy. So many life insurance policies like this one offer different kind of riders. So this rider that's offered at no cost has a guaranteed refund rider. So at the 20th year, all the money you put in, you can just take out. Like, let's say you're like, you know what, I don't need insurance anymore, I'm just gonna take everything out. Not a bad deal. Then it goes down when you start, aging more, but at the 20-year mark, if you paid everything into it, you don't lose anything. You can just get it all back. It also has accelerated death benefits. Now, most insurance has this accelerated death benefit, which you can pull it out. You can pull out 80, sometimes even 95% of the cash, or not cash, the death benefit face value, which is quite good because if you're gonna pass away, you get a terminal illness, they'll allow you to accelerate the death benefit in order to try and last ditch effort save or go into any kind of medical treatments that you want. Now, the chronic illness riders on this, which is again at no cost, is something that is very misunderstood. I had a client who got diagnosed with cancer very early. Luckily, I had sold him a cancer policy which paid him $40,000 to kind of handle and go through that ordeal. It made it easier to miss work and to be off and to kind of manage life with $40,000 in cash. But he had a policy that would allow him to accelerate the death benefit of his life insurance, which I said not to do, because the chronic illness, critical illness policies that are riders on the life insurance are based on life expectancy. So if you have life expectancy of 15 years, the accelerated death benefit amount goes down. So if you have a chronic illness when you're very close to your life expectancy, you're super close to 76 years old, then you can pull out this much. But if you get it, let's say 3 to 4 years after you get the policy and your life expectancy is still all the way down here, like 15, 14 more years of life expectancy, or even more, your accelerated death benefit for chronic illness is very little. Like here, it's probably less than $20,000, and you are accelerating the death benefit. So basically what you're doing is you're pulling out your life insurance policy. And if you're pulling out for something that's not decreasing your life expectancy, then you still might need the life insurance for whatever you bought it for, right? You still need it you need to replace income if something bad were to happen to you. And at this point, or at the point where you get the critical illness diagnosis, getting the money out is a good way for the insurance company to save money in case you died, right? Imagine they pay you $20,000 and then a few months later you pass away and you would have had a $250,000 policy instead. The insurance company is very happy to do that. So that's why it's very important to take a look at these policies before you do anything. And if this chronic illness rider is influential in your purchase, make sure you understand that when you use it and you accelerate the face value, you are losing the policy or most of the policy through this acceleration. Right? Many people don't understand this, but I'm pretty sure this is how it works. I've never personally done it, but I always advise against it because the life insurance is there to protect you in case you die. Okay? Do not create all these romances about like all these different things you can do with it, because the main point of life insurance is to protect you in case you die. Okay? And to go into my personal kind of like myself, the reason why I have a permanent policy is in case I pass away in retirement, I would need something to buffer the social security that I would be bringing in that would be missing if my wife survives me, which is highly likely because I'm a male of Polynesian descent who has a father who passed away before he was 60. So my chance of mortality is quite high. So I have a policy that hopefully will supplement that portion of the social security income that would not be there if I passed away. So that's the reason why I have a permanent policy. I also have a term policy which will last most of my working life, and then the permanent policy would be there to supplement if something were to happen to me after, right? And then there's the retirement savings, which is used to kind of bolster up and prop up lifestyle and income replacement and the social security, and then all that fun stuff, right? So that's how I view life insurance. So would I use life insurance for a bond replacement? Personally, right now in the status of my life, no, I wouldn't. But the great part is term policies, you can flip them into permanent policies, and you can use the same health rating that you were at that time. You just have to change the age rating. So if, let's say, I have a super preferred, which I was, but now I'm 40, then I would have a super preferred rating at the age of 40 for my new whole life or permanent life insurance policy, if it made sense for me to do that at that time. And then I could restructure that policy at that point to be able to fund something like this, like a $5,000 at that point. It probably in my head have to be at least $20,000 a year to make it worth doing, because then I'd be able to properly combat or properly put something in that would give me equivalent returns of the Treasury, but also the tax benefits, right, of not having to pay taxes on the loaned amount versus Treasuries, which I would have to pay. Now, another thing I just wanted to cap and say before I went, where's the IR? Here we go. So you will see this wonderful thing. Many people don't understand it. It's okay. It's not meant for you to study unless you're me. The IRR on cash value. This is kind of like saying how much return you're getting on the cash value. So one would think that it's close to 6.3, but it never gets there. Number one, because of the policy fees, and number two, because it's insurance and it's not going to give you that high of a average forever instant interest rate. It does cap out there on 4.91. So it is giving you like a bond return. So for somebody who is looking for bond-like returns in the tax advantage structure of life insurance, and you understand how the whole process works, how you can't borrow too early, or you can't do anything like surrendering too early because of all the surrender fees, and you also have to kind of keep an eye on if the policy has lock-in phases so that you can lock in when the market is high. If you can do all those things, then the life insurance might be a better option. Now for me right now it's not, because I'm young, 40 this year. I can just pump everything into the stock market. I'm 20 years away from retiring, and I probably would never retire, probably just keep working, because contrary to popular belief, going through this and looking through all of this is actually fun. I spent a good I don't know, how long was I? A few hours going through all this and finding the pros and cons, and unfortunately ChatGPT is not very good at finding pros and cons in this thing. It just didn't. It gave me, even though I fed it information that I am a financial professional and this is what I would do for clients, it fed me things that were very not to my liking. Very generalized, vanilla stuff. So I said, if you wanted to get something like this, build out a policy like this policy, I would only recommend if you are very conservative, understand that this policy is not to be touched, and when it is to be touched, you can only take out the amount that it tells you to, and that might not be really what you wanted. You might have thought it was more. It is not, in my opinion, a replacement for an investment portfolio. It can supplement your assets when it comes to your retirement or having assets to pull money from. But when it comes to somebody who only has $5,000 a year to put towards something, I would feel much more confident if you put it in a Roth IRA and just invest it in index funds like all the YouTube people tell you to. Or if you really had to, get bonds and buy bonds in a Roth IRA, or if you have the $5,000 a year to put into something and you need something super conservative, buy bond index funds, and that's, to me, if you went for tax efficiency and $5,000 is your notional spend, like the amount of money you have to spend, then that's probably going to be the best thing. Like I said, everyone's going to be a little bit different. There are reasons for people to use life insurance to hold, store, and grow assets, to store, cash. But for somebody who has $5,000, it's sometimes better to just use the traditional route, which is buying bonds, or even annuities. Annuities have gotten a pretty bad rap. I guess it depends on which side of the fence you're on. Some people love them, some people hate them. Some people think they're absolute trash. Really, it just depends on what you need, right? So for, like I said, this particular life insurance stuff, I'd only recommend doing something like this if you're super conservative and you need the tax benefits, whatever that is, the tax deferred growth and the tax free distributions by using loans, and you have somebody who is going to help you when it's time to do this, because life insurance is front-loaded front-loaded commissions. So if I sold this to you, by the time you're going to use it, I might be gone. And then you have to rely on some phone service agent representative to help you. Right? So you have to be able to understand how this policy works really well. And for $5,000 a year, I mean, yes, there are probably thousands of agents who would be more than happy to sell this to you. But I would say there's something better for you if you just took a more traditional route. That's kind of what I would say here. I just kind of wanted to just go through. I went through this wonderful exercise with ChatGPT, and I thought, oh, cool, I can try and relate it to real numbers and show you what's going on. So if that kind of stuff interests you, let me know. This kind of stuff I like to just geek out on during my free time. I thought I would share it with whoever wants to watch. All right, we'll catch you on the next time. Until then, do good things.